I want to talk a little bit about the government shutdown that we just came through. Cost the economy $11 billion. I think that's a conservative figure. There's at least one in this government that wants to use government services and public employees as a pawn when they don't get their way. But what I want to ask you about is that we are faced with a debt ceiling coming up March 1. Could you walk us through quickly, if you could, the economic impacts of failing to increase that debt ceiling?
Well, the failure to increase the debt ceiling creates a lot of uncertainty in the first instance, and then when you actually get up to the point where the government runs out of cash and doesn't pay its bill, we've never passed that point yet. That's kind of a bright line, and I hope we never do pass it. But there's a lot of uncertainty that's generated and a lot of distraction from what is otherwise a pretty good economy.
What would happen to our interest rates on $22 trillion worth of debt if we were not to do what we needed to do with the debt ceiling?
It's beyond even considering. The idea that the United States would not honor all of its obligations and pay them when due is just something that can't even be.
Would it double?
Considered. It would go up. I mean, I think we have the best credit rating. We borrow at very low rates, and the world believes in our full faith and credit. And I think that's not something I would.
It would have draconian effects on our economy overall.
Potentially, very hard to predict and possibly large.
But there's some that in this body, quite frankly, that say it'd be no big deal. Do you agree with that?
No, I don't. I think it'd be a very big deal to not to pay all of our bills when and as due. I think that's something the U.S. government should always do.